Great.
Morning, James. Morning, everyone.
Thank you for doing this. This is a brief bio of you, but as we've done with the other Troy funds recently, the past few weeks, you got a presentation to have a quick run through first.
Yeah.
So over to you. You just tell me when to move the slides. That'd be great.
Okay, perfect. Well, thanks for having me. Delighted to follow up on Sebastian and also James's recent presentations. And there'll be some commonality, but a lot that's different as well, because we're obviously talking about the Troy Income and Growth Trust, which is a UK quality-focused trust emphasising resilient dividend growth. We think it's an interesting time to be looking at the trust for three reasons. Firstly, in today's world, resilience is an important point. What is going on geopolitically and within markets, we think having that high quality, resilient focus is important right now. Secondly, the funds, or should I say the trust dividend yield of nearly 3% in an uncertain world is something that investors can take to the bank, and we think income is an interesting asset class right now, particularly quality income. And then thirdly, what we've seen in the past few months has been a decimation really of the more speculative areas of the market, of which we stay absolutely clear of, but also some quality companies that we invest in have for some reason or another been caught up in this, which is providing quite a nice entry point into some high quality companies. So let me take you through the presentation, and through that we'll cover three of those points as well. So Troy Asset Management is owner managed boutique set up by Sebastian Line back in 2001. We have about 15 billion in assets under management, 9 billion in equities, and importantly about 3.5 billion in UK equities. We've been doing UK equities here for 17 years, which is about as long as I've been doing it as well. And we have a unique approach to that, focused on capital preservation first. Our foremost objective is to protect investors' capital and increase its value year on year. And we do that through a quality bias and through proprietary deep research. Moving on to the next slide, you will know that Troy is quite quiet. We don't shout from the rooftops. We don't advertise overtly. We much prefer to do our talking through presentations such as this. But the one thing that we do shout about when given the chance is our passion for investment trust. This is absolutely central to Troy's business, and it has been ever since Sebastian started the business back in 2001, and we were absolutely delighted back in 2009 to be awarded Personal Assets Trust and Troy Income and Growth Trust back in 2009. And you can see on this chart, both have been very successful tenures for Troy over this period of time. Personal Assets Trust growing into a very significant trust and delivering fantastic returns for investors. And also Troy Income and Growth Trust, we are in growth mode. We want to grow. We will always be here in investment trust. We are committed to these. And that's evidenced by the fact that we also were appointed to the Securities Trust of Scotland, James Harries, in 2020, of which we were delighted. And so now we have the multi-asset Personal Assets Trust. We have the UK Troy Income and Growth Trust, and we've got the Global Income Securities Trust of Scotland. And each trust is known for being the low volatile version of its peers amongst its peer group, which is absolutely central to everything that Troy does. So turning to the Troy Income and Growth Trust, which is a UK equity savings vehicle, very much emphasising income and growth. We were appointed back in 2009, and we have always had a minimum of 80% of the portfolio in UK equities. We have a very clear and consistent approach focused on resilient, high quality income growth. And similar to Personal Assets Trust and to Securities Trust of Scotland, we're absolutely big believers in discount control mechanisms. We provide liquidity to investors through the active issuance and repurchasing of shares, which has enabled the trust to grow over time. It's also enabled our investors to receive a much lower volatility than a lot of our competitors. And it also means that our investors know that should they want to buy or sell, they will be doing so at a price that equates to NAV, or certainly at a very, very narrow discount or premium to that, which is absolutely central to our strategy on investment trust. As I said, we have the best part of a 3% dividend yield, which in today's world, I think is pretty attractive. And I will take you through why we think that dividend yield has an ability to grow and to provide resilience to investors. So what do? We are all about high quality, resilient income growth. And what we're trying to do is invest in high quality, resilient companies that can ultimately grow their dividends. And we do that through investing in UK companies predominantly, but also some international, and we'll talk about those in a bit. And therefore that has very clear implications for who the trust is for. I mean, I have always thought, and this is on the next page, James, I have always thought that the trust, and it actively is, it literally is in my household for my mum, it's for me, and it's for my children. My mum wants an income stream today in retirement. I may want an income stream at some point in the future, hopefully no time soon, given I've got plenty of time on my side in my career. And then also it's my children who don't need an income stream today. They're unlikely to need one anytime soon, but they want to invest in the trust, or I want them to be in a trust that provides a resilient total return. So whether you want income today, whether you want income tomorrow, or if you just want a defensive total return, that's who we see the trust as being for. And absolutely, by definition, the trust is not a trust that is reaching for high yield. We actively avoid high yield. We think that's where the biggest capital risk comes. We are absolutely not an index tracker. We're an active fund, an active portfolio, an active trust that actually eschews and avoids much of the UK market, particularly the cyclical, capital intensive areas of that. And we absolutely are not speculative. We're the complete opposite. We're fundamental long-term investors. And those are who we tend to attract as investors in the trust itself. Moving to the next slide, we are all about delivering above average returns with below average volatility. And if you look at the trust's history since 2009, you've basically received, or an investor since 2009 has received a total return of about 9%, split between income. Today, income is about 3% of the trust, and capital growth, which has been steady over those years. And it's also the shape of those returns that are very interesting to dissect. Here you can see in blue the yearly returns of the Troy Income Growth Trust versus the FTSE All-Share in red. And I'd really highlight years such as 2011, where you saw the market deliver a negative return, the trust deliver a positive return. 2014, 2015, very similar, much better protection of capital and growth of capital in difficult market conditions. And we saw that again in 2018 and 2020 as well. The flip side of that is in years such as 2013, actually 2021 and year to date, when the market is much more pro-cyclical, we tend to lag those returns. But that is very, very similar to Troy's way of delivering returns. We much rather look after the downside. We much rather protect on the downside to make sure our investors can sleep well at night. So that's above average returns. Looking at the next slide, it also comes with below average volatility. We are the least volatile trust in our peer group. You can see you want to be top left of this chart, delivering high returns below annualized standard deviation. And that is absolutely something we seek to do and have done over the past 13 years. Moving on to how we actually deliver above average returns and below average volatility. Well, this is how we do it. We invest in a certain type of company. We look for resilient, high quality dividend growth stocks, and we eschew and we avoid those kinds of companies that can't do that. We avoid companies that have high cyclicality, as you can see in red of this chart, and we also avoid companies that have high levels of capital intensity. We really think that it's that cross section between high capital intensity and high cyclicality where you're most likely to impair capital over time. And instead, when there's a cross section of low capital intensity and low cyclicality, as you can see in green, that's where we tend to invest. And so when you think about from a sector level, and this is important, when you think about the return profile of the fund, we literally will not invest in banks, in oils, in mining companies, in life insurers, airlines, house builders. And instead, we tend to find our best ideas in those companies that have repeatable economics, so subscription software businesses, consumer staples, pharmaceutical companies, and the rest. And this next chart looks at exactly that point. What we're really emphasizing is recurring cash flows and dividends, and this comes from various parts of the market. We have long had a preference, top left, for repeat purchase consumer goods. You know, the beauty of the products that these companies produce is that they're recurring in nature. When you run out of your Nespresso coffee capsules, or in my household, the never-ending supply of Pampers nappies, which is owned by P&G, you know, they're low price in nature. They have to be replenished, providing very, very resilient cash flows and dividends from these companies. Top right are more the enterprise software companies that we like. Paychex is a US HR and payroll software company. Relex and Experian, I would argue, are the UK's best two software companies and technology companies. Bottom left, engineering and industrial companies, which is a real bright spot of the UK market. Companies that have vital products and provide vital products to their customers at a very low cost. And when you think of something like Diploma or Croda, you know, whether that's Diploma providing mission critical seals to their industrial companies, the industrial customers, or if that's Croda supplying magic ingredients that go into anti-aging creams or vaccines, absolutely central to the efficacy of those products. And then finally, bottom right, contracted income. This is about 10% of the trust. Companies that are very well placed in this inflationary environment, such as National Grid or London Metric, which has built up over the past 5-10 years an enviable portfolio of urban logistic assets that are very well placed in this digital age, where increasingly we're buying more and more online, getting things delivered constantly to us, and London Metric are very well placed there. So taking a step back, recurring cash flows funding recurring dividends to resilient companies. On the next chart, this is a good way of looking at what you actually own if you are invested in the trust. This is how we see it. This is not necessarily FTSE or GICS sector classification. This is how we see the portfolio of the trust today. And what it is it's a portfolio of resilient, high quality income growers that have multi-years of free cash flow and dividend growth ahead of it. So 25% of the trust in purple, you can see from these high quality consumer staples companies, about 25% from software or data centric businesses, both in the UK, like Experian and Relex, which I've mentioned, but also the likes of Visa and Paychex from overseas. About 11% of the fund, of the trust, the portfolio are from consumer discretionary stocks. We particularly like franchise business models like Domino's Pizza, Intercontinental Hotel Group, and then 10% in these higher quality industrial and engineering companies in yellow, the likes of Croda, Intertech, Diploma. About 8% in REITs, London Metric being one of them, 10% in healthcare, only 7% in financials. We're not big buyers of banks, of life insurance companies. We like fee income type businesses, the likes of Schroders is a good example. And then finally, 6% in utilities, such as National Grid, 3i Infrastructure, IMPP, which produce us with highly resilient dividends and cash flows. And when you take it in its entirety, taking a step back, what we have here is a portfolio of highly resilient income growers that produce resilient returns for our investors. The next chart looks at our top 10. This is a concentrated portfolio. If we just turn to the next slide, thank you, of high quality companies that produce this resilient income growth. The nice thing is, for the end investor, many of these companies people will recognize, whether that's Diageo, our biggest holding, the owner of brands such as Johnny Walker, Guinness, Casamigos Tequila, or if it's companies such as Nestle, one of our overseas holdings, which we've actually owned since we've been managing the trust, and one of our top performers over many years. But taking it in its entirety, about 45% of the trust is in the top 10, a concentrated portfolio of high quality companies, many of which are multinational leaders. And that's evidence on the next page when you look at the underlying revenue exposure of the trust. When we think about today's world and the difficult things happening geopolitically, I can reassure investors that we have incredibly low exposure in red to what is happening over very tragically over in the Ukraine and in Russia. Our exposure to Russia is very low, and actually, if you were taking a live snapshot, given so many companies have pulled out of Russia, quite understandably, that exposure would basically be zero going forward. But very importantly, we definitely have a bias towards diversified companies. We have a bias towards multinational companies. It provides resilience for our investors. And also, we have a very strong preference for a certain market. And you can see that by the fact that the biggest proportion of the underlying revenue that our companies produce comes from North America. And we really like the North American market. And one thing that isn't talked about that much in the UK market, yes, we have UK champions within the portfolio, but also we have some of the market leading US businesses that really have fantastic market positions and an ability to grow over many years. You think about Diageo, the US biggest spirits business in the US. You think about Compass Group, biggest catering company in the US. You think about Experian, the biggest credit bureau in the US. Many examples within the portfolio of companies that have dominant positions in the US market, which I would argue looks even better than ever given today's backdrop. Just looking at the portfolio, when we think about companies, we always assess them based on three metrics. In trying to produce high quality, resilient income growth, we think about quality, we think about growth, and we think about yield or valuation, if you want to call it that. And I just thought I'd take you through some of these metrics that you can see through the portfolio and what it may mean for the future returns for the trust on a long-term basis. Firstly, quality, high operating margins. I think in this inflationary environment, that will be quite important, 20% plus operating margins, high return on invested capital in the teams. And then very importantly, we have growth embedded in the trust. This is consensus forward data, so take it with a little bit of a pinch of salt. But when you just look at the 10, it's not controversial to see decent sales growth embedded within the portfolio, good earnings growth embedded in the portfolio. And then also when we look to yield, are we paying reasonable valuations? Well, a 5% earnings yield that comfortably covers the dividend yield of 2.8%, we think is a very good place to be today. Not only are you getting that certainty of nearly a 3% dividend yield, but it is very well covered by the earnings yield of 5%. And that gives you two messages. The first, the dividend is sustainable, which is incredibly important to us, but also because there is a spread between the earnings yield and the dividend yield, it means that our companies are on average retaining about a third of their cash flows. And why wouldn't they retain some cash flows when they can reinvest at high rates of return, which keeps the growth going on a forward basis? So when you think about TIGIT, it's basically delivered 9% compound for investors over the past 13 years. And when you think on a forward basis, we've got 3% as a dividend yield, and then we have earnings and sales growth at the mid to high single digits. I don't think it's controversial to assume that maybe we could deliver similar returns that we have in the past into the future as well. So wrapping up, James, before I take your questions, I just have three key messages. The first is that we are absolutely a quality-focused trust for the long-term saver who seeks resilient income and growth. We expect market volatility to continue this year. I don't think that's controversial given what's happening with interest rates and geopolitics, but valuations are increasingly compelling, particularly in higher quality companies, some of which have been left on the shelf this year in favor of more cyclical commodity stocks. And then my third point is that companies are in great shape. We've gone through a period just now of meeting a lot of companies. We're right in that kind of full year Q1 reporting season, and we're very reassured by what our companies are producing. And that enables us to believe that we will be able to produce 13 more years of resilient income growth through high quality companies, much as we have over the past. So with that, I'll open up to questions.
Great, thank you very much, Blake. Let's start off with a question here about financials. So What is it that you don't like about banks and insurance companies, especially given that they should be beneficiaries of rising interest rates?
Yeah, I think it's about time horizon. And this should be a feature of a lot of investors right now, is that everyone's time horizon right now is shortening and shortening and shortening, I believe. And that's inevitable in a period of heightened volatility. But we need to zoom out. We need to think about the way that we invest at Troy is seeking companies that can produce resilient, high quality income growth over many, many years. And we don't look to trade in and out of companies. And we look to hold companies preferably into perpetuity. And when we think about that, companies that risk their balance sheet in order to make their profits, to make their returns on equity, we see over repeated cycles that they don't do that consistently. Instead, we like companies that earn fee income, that don't risk their balance sheets as part of their ongoing business. And so whilst in the short term, perhaps banks may benefit from a steepening yield curve, albeit if the yield curve continues to flatten and invert like it is now, or we get a recession, I struggle to see how they will perform very well. We're much more drawn to these companies that can produce cash flow on a regular basis, because those are the businesses that will produce the dividends that will recur. And so we very much focus on those areas of the market that can do that. And we don't think that banks and life insurers and the rest will do that over time. The second point I would say, and just very briefly, is these are incredibly complicated investments. I actually had the displeasure of covering life insurance at some point in over the past 15 years in one of my previous roles. And they're incredibly complicated companies to invest in. Balance sheets are incredibly difficult to get behind. And ultimately, they're reasonably low return on equity businesses. And so we see better opportunities as well.
Yeah, I sympathise with that. I tried to do life insurance about 25 years ago. Yeah.
I think those that, unless you're an actuary, and even so, seeing the wood for the trees. When you're underwriting risks based on assumptions in a changing world, that worries me, and we stay clear of that.
Fair enough. How do you go about sort of controlling risk within the portfolio? How do you actually sort of measure the exposures to things like oil prices and inflation and manage those?
Yeah, we do it on an absolute basis, and this is a very important point when you think about the trust and you think about what's happening, particularly year to date. I've actually got a slide on this, James, on slide 20 that may be worth looking at. Now, Troy was almost pioneering back when Sebastian founded the company in thinking in terms of absolute returns, in avoiding index hugging, in thinking about of being a very active, concentrated fund. And that does have very clear implications for our relative returns over short periods of time. And we know that in the UK market, about 35% of the UK market is exposed to banks, oil and miners. And as I've said, those are companies that just don't meet our quality criteria. You don't see these companies in any of the Troy funds, whether that's Sebastian, James, Gabriel's or mine. And so when these companies perform very well, as they have year to date in a rising commodity price environment, we do tend to be to lag the index in those environments. But we think about risk in absolute terms. And so whilst we may invest in some engineering companies or some high quality industrial companies that have some exposure to oil and gas markets, an example of that would be Aviva, the software company. But we would much rather own a software company that has some limited exposure to oil and gas, rather than the commodity company itself, which is a price taker and is completely at the mercy of what oil prices are going to do in a short period of time. So when we think about risk in absolute terms, we're always trying to avoid permanent capital loss. We are always drawn to the most resilient, high quality companies in the market, and that can have very clear implications for what we will and what we won't own, and it will also have very clear implications for short-term relative performance, and it's something for investors to be aware of.
Actually, it leads into this question that's been asked here. So what sort of time horizon do you think an investor in your fund ought to have?
I think it's I think when we look at companies, we invest with a 5 to 7 year time horizon. Now, that may be too long for some people, but the nice thing about an income fund is that you do get a return. You get an uncertain capital return, obviously, but you get a return immediately. As I said, about a 3% dividend yield, the best part of at the moment. And so I would always implore investors to take at least a 3 to 5 to 7 year view when investing in equities. If you can take longer, that's even better. But our investors understand that we are long-term investors, and we tend to attract similarly so long-term investors.
I think you had it. So what was the yield on the underlying portfolio? Was that 2.8?
Yeah, on a forward basis, the yield on the portfolio is 2.8%. Obviously, with the investment trust structure, fees are taken partially out of income, and so that translates to just north of a 2.6% dividend yield at the trust, with good growth embedded in it as well.
This is quite an interesting one. So if you think about dry income and growth relative to Securities Trust of Scotland, are you actually really investing in very similar companies? Does it just come down to where they're listed?
Absolutely. I mean, that's we at Troy we have we all invest off one investment universe. We have an investment universe of 170 companies, and from that investment universe, and if you think about some of the features of the companies on that investment universe, it's high quality companies, it's resilient companies, it's companies without a lot of debt, it's companies with an ability to grow over multi years. They're cash generative companies that can ultimately fund themselves, and particularly when you think about what James is doing and what I'm doing, it's companies that can fund dividends from cash flow over many years. And so inevitably, when we invest, because we're all picking from the same 170 stock investment universe, there is overlap. And James obviously is a global fund, and so he can invest everywhere. And Troy Income and Growth is very much a UK focused trust. We have about 80%, 82% of the trust invested in UK equities, and then we have about 16-17% of the trust invested in overseas holdings. But ultimately, what are we all about at Troy? We're all about high quality, resilient returns. And what is James and Securities Trust of Scotland and Troy Income and Growth about? It's about high quality, resilient income growth. I do it predominantly through UK companies, and James does it through global companies.
Okay. Gearing is an interesting question. So is there any gearing in the portfolio now?
There is not. I think this is an interesting question. The trust has had the option to be geared, obviously being an investment trust. It is something that has not been used in the past. Troy, as one would expect, is a cautious house. We will never be a trust that is speculative, overly geared, but it is something that we are looking at, and I don't think it would be unreasonable on a medium-term view to, particularly with market weakness, particularly with weakness in the kind of companies, some of the more resilient and high-quality companies in the UK market. It's something that we talk about. So just because we haven't been geared in the past, absolutely don't think we won't be geared in the future. It's something we discuss on a regular basis and are discussing.
And if you did, would it be short-term kind of flexible gearing, or do you think it would be long-term?
Yeah, we avoid long-term gearing, particularly we avoid structural gearing. That's not something that the trust will ever do, particularly with the fact that we have that discount control mechanism where we provide liquidity on the way in, on the way out. We won't be taking on some of the long-term structural gearing that others do. but so we'll be flexible. But look, the nice thing about this portfolio, because we're investing in high quality, resilient businesses, because we're the least volatile trust in our peer group, both over 2 years and since we've been managing the trust, it does lend itself to some modest gearing, particularly when valuations are on our side.
Valuations, yes, just put into this now. So the question is, if you're investing in higher growth companies, does that mean they're more expensive than average?
Yeah, I think on slide 23, this might be worth looking at, James. And I think particularly in today's environment where there is uncertainty and where there is inflation, there's two things that we're really, really focused on right now. Firstly is the resilience of cash flows. And I think we feel pretty good about that. We do invest in companies, as you can see here, that have high and stable margins, that have low asset intensity, are highly cash generative, that should be able to deliver real growth through most market conditions. So the point on resilient cash flows we feel very good about. But of course, as with anything in this world, the higher the quality is, or something with higher quality, with more certainty, we should be expecting to pay slightly higher multiples for those companies. And higher multiples and value are two different things, or low multiple equating to cheapness, as we have been reminded on so many occasions, is not necessarily the case. And so what we look for are reasonable valuations. And when we think about the forward return that the trust is trying to deliver, if you think on a historic basis, it's delivered 9. When we think about forward return from companies that we invest in, when we think about the earnings yield on the trust, about 5%, we think we have mid to high single digit earnings growth embedded within the trust. And so we think a 5% earnings yield for mid to high single digit earnings growth from highly resilient, high quality companies, we think that's perfectly reasonable in most backdrops.
So do you think then that the portfolio is actually quite well positioned when it comes to things like inflation?
I think there's a first order effect and second order effect. And clearly the trust has had a tricky start to this year, because the kind of companies that we like to invest in, and this is again on slide 20, James, the returns this year have, and this is the first order effect, I would say, of inflation, it has benefited the commodity producers when the oil prices gone as high as $130 a barrel this year. It's not currently that high, but it got up to that level. A lot of people are speculating, of which I have no idea whether it will or not, that oil may go to 150. Some people are even saying 200. We're in this game at the moment where people are trying to name the highest number, both in terms of interest rate hikes and also commodity prices. And therefore, the first order effect is that has seen investors, I think, rush into the commodity producers at the expense, as you can see at the bottom of this chart. This looks at sector performance year to date within the UK market, at the expense of some of the more higher quality companies that we like to invest in. Consumer staples a negative return, technology a negative return. And so the first order effect has been to sell higher quality companies and to buy commodity producers. Now, the second order effect, I think, is the $1 million question, isn't it? From here, I can see this going one of two ways. One, inflation sticks around and really starts to hamper growth and more discretionary items, and end demand is impacted, and perhaps we flirt with a recession, as the bond market seems to be telling us, with a flattening, if not inversion, of the yield curve on the way. In which case, I think higher quality companies or less discretionary items, such as enterprise software and consumer staples that we tend to like, will perform very well. Or from here, given expectations for inflation and interest rate hikes are now very well captured within markets, in my view. And that wasn't the case 6 months ago. Interest rate and inflation expectations have moved materially. And so from here, we think that that's in the short term certainly quite well priced in, and so a more benign environment if the Fed can't raise interest rates to the level that people think, if the Bank of England has to hold back from more interest rate rises at the end of this year, I think again that will be a much better environment for quality companies. So look, we don't try and play the crystal ball game, but given where expectations and valuations are, I think leaving quality companies on the sideline is quite a dangerous game, and that's very, very different. And I just want to make this point. I think it's very different. The high quality companies that we invest in that have some growth, of course they do. We should want our companies to have some growth, but they're not the fastest growing companies out there. They're growing mid to high single digits. In some instances, like Experian, thankfully, are growing double digits. But on the other hand, when you see high growth companies, these speculative growth assets, particularly within the technology sector that have really been decimated, that's a world away from Diageo, Experian, Croda, Paychex, and the kind of companies that we invest in.
Are you concerned about the relative performance of the UK to places like the US, for example, in terms of maybe outlook for like recession, perhaps?
In terms of what? I'm sorry, James?
Well, do you think that there might be, do you have to factor into the portfolio whether you think there might be more chance of a recession in the UK than the US?
Yeah, when I think about the UK right now, I think the UK, I personally, I think this has been the case for a very long period of time, and it's perhaps being exaggerated even more so of late. When you think about the economy, the UK is better than Europe. Demographics, indebtedness, kind of cohesion, but the US is better than the UK. So if I was to rank, particularly in the West, the US economy versus the UK economy versus Europe, it would be in that order. Now that's different from a stock market perspective. In terms of, as I said earlier, the UK is very lucky where we have some really high quality overseas and US businesses. It might be worth just flicking to our top 10 on slide 12, if you don't mind. And if you think about the portfolio, and this isn't by accident, you think about Diageo, the US's biggest spirits company, Relics, dominant position, particularly in its risk division in the US, Experian, the US dominant credit bureau. Reckitt and Unilever obviously have good US businesses. Paychex is a US business. It's supplying HR and payroll software to small and medium-sized businesses in the US. Nestle obviously has a US business. Glaxo likewise. Croda has a very good US business, and even National Grid. Some of your listeners may not know, but one of the attractions of National Grid is the fact it's not just UK centric. It also has assets in the US, which are very unique and highly valued. And so the nice thing about the UK stock market is that we can get that diversification of revenues that you can't get in other markets. And so whilst we do have some UK champions, some of our financials, Next, Domino's Pizza, we also have some of these international, some of the best international businesses in the world. And so we like to play that.
You have to think about strength of sterling. Would you ever sort of hedge currencies in the fund?
It's something that we keep an eye on, but generally, when you see sterling strength at the margin, that tends to be a bit of a weakness for the trust when you see dollar weakness and sterling strength, as we actually saw coming out of Brexit. We went through a period where UK mid caps, the FTSE 250, performed incredibly well. That was at least in part because of, I suppose, the Brexit discount unwinding, but also the strength of sterling versus the US dollar. When we look at it, I don't have strong views, but I quite like the dollar versus euro and the pound because of the strength of the US economy over time. Some of the criticisms that people throw at the US economy, I still think it's less bad on a lot of those things, whether that's demographics, indebtedness, growth, than the UK and Europe. And so we don't tend to hedge them. We have a lot of diversification within the portfolio. And also remember, the UK market as a whole is highly international. In fact, some of the bigger stocks in the UK market that we don't invest in because they're not high quality, they're not resilient, are dollar earners as well. So we're not out of whack with the index in terms of our currency exposure. And it's all from hard currencies such as the dollar and euro and pound anyway.
Okay. Probably got time for one more, maybe, which is sort of, let's see. Actually, maybe could you explain the discount control mechanism, how that works? That might be quite useful.
Absolutely. And we actually have a slide on it at the back on slide 28. And this is a very clear feature of our investment trusts at Troy. I think Personal Assets Trust was almost pioneering and led the way in terms of this, and it's something that Tidget and now Securities Trust of Scotland are big believers in. And I know it's a feature for some investment trust investors that they like to play discount and premium and play that off and see that as an opportunity. But over a long period of time, we don't like the volatility that brings to investors. We will stand by the trust, and when we are trading at a premium to NAV, which we have done at many instances over the trust's life with us over the past 13 years, we will issue shares to make sure that the price realized is in line with NAV. And likewise, right now, as you're seeing a bit more of a value rally, as you're seeing people more interested in some more cyclical companies, the trust currently is trading at a modest discount and is therefore buying back shares in the market and has been doing so of late. It tends to be at a very tight range around NAV. Think about a few percentage points, a couple of percentage points either way. And we think that's really important in delivering lower volatility. It's also very important in terms of being able to grow the trust when we issue shares at a premium. And it's also very important in terms of providing liquidity to our end investor, which is something we think about a lot. So big believers in discount control mechanism, and over time it's worked very well for us and for our investors.
Great. Okay, thanks very much, Blake. I think we've covered a lot of ground there. So we will follow it with interest, and probably in about a year or so we'll have you back again.
My pleasure.
Thanks for this. Okay, let's come through to the end of this. Here we go. And then look at what we've got lined up. So we'll be sticking with the UK equity income theme. So next week we'll be talking to Ian and Nick from Red Wheel about Temple Bar. And we'll also have our normal kind of monthly roundup of things with Andrew Hattie. And we have got somebody on that for the 8th. I think it's a sort of debate between two managers at the moment. I can't tell you which one's won. But one of those will happen. Then 15th is Good Friday. And then we've got a full roster of things going forward. So thanks for tuning in today. Good to see some of you at Master Investor. And hopefully we'll see you again next week. Thanks. Bye-bye.